So I think the key takeaway for us is that after a very difficult period for real estate performance, 2025 looks like a very attractive year to deploy capital. Why is that? Well, in the markets that Zurich Insurance primarily invests, valuations better reflect the interest rate environment. Occupational markets are holding up reasonably well, and supply pipelines have appropriately recalibrated.
You mentioned the opportunity when it comes to offices, and we were having a terrific conversation with Skanska early today about whether we truly bottomed in the commercial real estate market thanks to people coming back into offices and those mandates that are changing from the COVID era. What do you see on some of the valuations? How far are we when it comes to this real estate cycle in terms of getting out of that trough?
Well, I think a bit of context on occupational markets is first important to understand the valuations. In 2025, we expect more employers to be asking their employees to return to the office. They have greater leverage and they have greater bargaining power. I think they'll do this as a function of trying to improve workforce productivity or reinvigorate corporate culture. This should ultimately put a floor on the negative sentiment which has plagued the sector for the last couple of years. What does that mean for valuations? Well, I think valuations are probably finding their floor in the office sector. Again, it's been a tough few years with valuations down anywhere from 25 to 35% depending on the market. The good news is with valuations finding a floor and more employees back in the office, we expect that investors will adopt a more constructive stance to the sector. We expect liquidity to improve and more investors returning to the office sector generally.
Andrew, lovely to see you, by the way. OK, let me roll with that. I would agree with you and sounds great if it wasn't for the fact that a couple of miles down the road from here, down at Canary Wharf, they're desperate to change the buildings, change some of those tower blocks, change the focus of their building to residential rather than office as well. What am I missing here?
Well, I think you got it spot on. The office story continues to evolve. Mixed use is the future. I think the experience over the last 5 years is monolithic city centers with one use really struggled. By incorporating residential and other uses, education, even last mile delivery into historic office districts, you're reinvigorating areas, you're bringing more people and more commerce to an area, and this ultimately is good for valuations.
Yeah, and Andrew, there was a fear that we had too many high-rise, too many tower blocks with office space in the City of London. So people just hold off a little bit as well. And then they're thinking about, well, do we go for the new ones? Do we try and get planning for those? And it's a mixed relationship, for instance, with the City of London, as you know, with the real estate developers as well. Where are we at in that balance now? Is bigger better, or actually are we talking about smaller units?
The story we've been talking about for the last 5 years, which continues to resonate, is one of best versus the rest. As employees have greater leverage asking their employees to come back to the office, employees are saying, we'll come back, but we want better space. We want productive, healthy space. And as a consequence of that, we've seen a proliferation of development of top quality product. And occupiers are willing to pay rents for those types of buildings. And the City of London in particular is benefiting. We're seeing rents being achieved in the city now at or even slightly ahead of the West End, which is a new phenomenon for the market.